May 21 showed a split. The indices were green, but corporate behavior was defensive. Intuit cut 17% of its staff. Walmart mourned about fuel costs. PMI data showed firms stockpiling parts and cutting jobs as costs rose. The surface looked calm, but the underlying move was margin defense. The closing numbers were modest. The Dow gained 0.55% to 50,285.66. The S&P 500 rose 0.17%, and the Nasdaq added 0.09%. Stocks struggled early but recovered as oil prices turned lower. It was a recovery for the tape, but the internal signal remained tense. Oil moved to the background today. Reports of U.S.-Iran talks showed some progress, while uranium and the Strait of Hormuz remained sticking points. That was enough to pull crude prices down and give stocks some air cover. Relief is helpful, but it is not a resolution. The real news was coming from corporate boardrooms. The manufacturing PMI hit 55.3, the highest since May 2022. On the surface, that looks like a boom, but services slipped to 50.9. The manufacturing strength was not driven by fresh demand alone. Companies were building inventory because they were worried about supply chains and rising costs. Stockpiling is a defensive move. Input inventories hit an 11-month high as firms built safety stocks. Supplier delivery times stretched out. Input prices jumped to their highest point since mid-2022. Companies are bracing for a more expensive environment, rather than simply expanding. Labor is becoming the pressure valve. Overall private sector employment fell to a 21-month low. Services employment actually contracted. When costs rise and the outlook is murky, management teams start cutting heads to protect the bottom line. That is the margin defense loop in action. Intuit turned that abstract pressure into a concrete story. The company is reducing its workforce by 17%, which is nearly 3,000 roles. Restructuring charges are expected to run between $300 million and $340 million. The stock dropped 20% after the company lowered revenue forecasts for TurboTax. It was a sharp reminder of what happens when growth slows. The narrative is shifting. Intuit talked about AI-native products and flatter management, but the market focused on the cuts. The company is shrinking because the old business model has less room for error. Investors are starting to value immediate efficiency over long-term promises. Walmart added to the consumer caution. The stock fell over 7% after a weak profit forecast. Their CFO pointed to high fuel prices squeezing shoppers. If these costs stay high, retail inflation could rise through the end of the year. The consumer cushion is getting thinner. Nvidia still matters, but today showed the limit of one leader. The company gave upbeat guidance and a big buyback, yet the stock fell nearly 2% as investors took profits. The chip sector stayed positive, but the day proved that one leader cannot hide the cracks appearing in other sectors. Risk appetite has not disappeared. Reports around a SpaceX IPO filing had traders talking about a valuation above $1.5 trillion. The exact number matters less than the sentiment. The market still wants to bet on scarcity and big dreams, even while the everyday economy is tightening its belt. The watch list is simple. Watch services employment and retail guidance. See if input price hikes start hitting the final consumer. Watch if other software firms follow Intuit's lead on headcount. Keep an eye on oil, because any new spike makes these margin problems even more painful. The takeaway from May 21 is that green tape can hide a lot. Stocks rose because oil eased, and buyers still chased big stories. But companies were also cutting jobs and warning about cost pressure. The market's real support is no longer just about oil or one stock. It is about whether companies can protect margins without damaging demand.